property than it is on a primary residence. It's called a loan level pricing adjustment. Well, since Fannie Mae and Freddie Mac are in government conceivership and being basically ran by the Treasury, they're sending a lot of money to the Treasury, and the Treasury is realizing that, and they're using that income to fund other aspects of the government, and they're artificially increasing interest rates. So over time, over the last 4 or 5 years, those adjustments have increased, and interest rates on conventional home loans have gone up, even though interest rates overall have come down. And that's why you have that spread, right? An FHA VA home loan might be 2, 2.25, 2.5. A conventional home loan might be 3. That's why there's a gap between conventional home loans and government home loans. Does that make sense?
Yeah.
We had talked about that, and you were like, that might be something that I relay. So sometimes when we're looking at customers and we're saying, hey, like, you're like, well, why are you guys going FHA? I'd rather have the client go conventional.
Yeah.
Well, FHA has a much lower interest rate sometimes because the FHA interest rate is more of a true market interest rate versus what conventional is offering. Does that make sense?
Yeah.
More well-qualified borrowers, we're always going to gravitate to conventional home loans, people with lower credit scores, and that could be under, like, you could have a 690 credit score, which is actually a decent credit score, but looking at an FHA home loan might offer that customer a lower payment.
Got it.
Make sense?
Yeah.
What is like the interest rate, like the difference though? Say you have like a 2.75 versus a 2.99, what is like the actual savings?
It all depends on the loan amount.
Okay.
Right? So, because the loan amount, on a lower loan amount, an 1/8 or 1/4% in interest rate, $20, $30. On a larger loan amount, $400,000 or $500,000 loan amount, it could be $100.
Right, and then that's going to affect obviously how quickly you pay down your principal just by ever so slightly.
Yeah, the monthly. Well, it's not going to impact because if someone's doing a 30-year fixed loan and $200,000 loan or a $300,000 loan, that loan's going to be paid off in 30 years. So really, the time in which they pay it off is going to be the same. Their mortgage payments, the amount of principal and interest that they pay will be higher because they're financing more. Makes sense? But that's the one thing we love to talk about is I think I love mortgage, but I hate debt.
Yeah.
Right? And having conversations with customers about what an extra $50, $100 does to their principal over time is dramatic. I mean, it really does save money over time. And that's where I think when we talk about finance real estate smart, like that's what we do. When we're talking with customers, we're talking about ways in which they can save interest over time. Because I believe rate's really important, but I think strategy at times is much more important. Right? What program are we using? What rate are we getting? How much money? Why are we putting so much money down? Why don't we take some of this money and pay off debt instead? Save the household $1,500 a month overall, which makes that new mortgage payment that's $500 more a month a lot more
easier,
doable.
Yeah,
right?
For sure.
Because $50,000 towards your mortgage is a couple $100 a month, but if you pay off two $50,000 cars, it could be $800, $900 a month in savings.
$1,000 a month, yeah.
Yeah. So what? Right. So I don't know if that's helpful. And then the only other thing I just wanted to touch base on is recasting. So you guys know what a recast is? So this is on kind of the move up situations. And so we can do a home loan for a buyer where maybe they put, let's say they have an IRA. Well, you can take money out of your IRA, and as long as you put that money back in 60 days, there's no penalties for doing it. You've got a 401k. You can take a loan against that 401k, and that's a loan. The money's still in the market, right? If the market's going up, it's still going up because you're just doing a loan against it. There's no penalties to withdrawal, and you can pay it back whenever you want. So if someone has a 401k that maybe we take 5% out of that 401k for that down payment, if they can qualify for both mortgages, they buy that house, right, with the money from the 401k, then they sell their house, and then the proceeds that they get from selling the home, they pay back the 401k, and they apply towards the mortgage, and they do a recast. So on a 30-year fixed loan, when you make a principal reduction on a traditional 30-year fixed loan, it goes directly to principal, but your payment doesn't change. So the time in which you're going to pay off that loan does decrease, but the payment that they have doesn't change. Now, when you do a recast, the lender is recasting the loan over the remaining term based on the new principal balance and the original interest rate. So that'll give them a new payment. So sometimes clients are like, well, I want to buy this new bigger house, but I don't want this big payment at, what 95%, financing 95% of the value. So how do I get that money out? Well, we just tell them like, okay, buy the house, you'll have that little higher payment temporarily, but as soon as you sell your property, take the money from the property, put it towards the principal, and do a recast and get yourself a new lower payment.
How soon can they do the recast after?
Immediately. Now, not every lender does recasts.
No, some make you wait 3 years.
Correct. Yeah, so we allow for a recast immediately after them closing. Our stipulations are, it has to be at least $10,000, so they have to bring at least $10,000 to the table, and it's about a $350 recast fee. That's it.
Look, so walk through the program again. I thought they needed 20% down on the next house. Can they do it as little as 5%
We can
down?
do a 5% down purchase on the new
So
property.
the loan program doesn't matter. It could be a conventional loan, 5, 10, 15. So see, these are and I talked about this with Nicole and
Yeah.
Andy before.
Yeah.
So there are no additional fees to make that happen. Is the rate higher on?
So what's interesting, if they can do 10% down, they'll get a better interest rate at 10% down than they will at 20% down. And the reason is the lender is getting mortgage insurance on that loan. So it's actually safer for the lender. Does that make sense?
Yeah.
Now 5% down is a higher interest rate than 10% down, but if they put 10% down, it actually is a better interest rate than 20% down, and that is completely reverse to what your traditional thinking would be.
Yeah.
Right?
Yeah.
Now if they put 25% down, then they're going to have a better interest rate than 20% down.
Sure.
But if we can get them to that 10% down mark, right, and they can pull money from a 401k or somewhere, borrow money, get a gift from a family member,
Yeah.
right? Like, let's just think creatively. So you talk about bridge loans. Bridge loans aren't really available
Okay.
right now. They are very expensive. They're hard to do. I don't have access to one.
Got
But
it.
we can think differently
We
about
do
how we
recast.
utilize our money
Yep.
and potentially do a recast.
Got it.
And then mortgage insurance on a conventional home loan is not permanent.
Yeah.
So if they do a principal reduction inside of the first 2 years, and as long as the value of the property presently is no less than the original purchase price, the mortgage insurance goes away.
For conventional.
For conventional.
FHA is for
FHA is
life.
permanent.
Yeah.
So we wouldn't do this with an FHA home loan.
No.
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 I mean, maybe, but they're gonna have mortgage insurance, so it's gonna be a really costly.
The
way to
only
do it.
fee to make the recast happen is the $350 recast.
$350
Hmm.
and a minimum $10,000 investment.
Yeah.
You know,
And they
a
keep the
principal
same
reduction.
interest rate?
Yep, same interest rate. So if rates go to 5, 6, 7%, they just come in with their cash and do a recast.
Can they do it anytime?
Huh? 6, 7, 8, 10 years down the road. It's a Fannie Mae and Freddie Mac thing. It's an overlay for a lender to say no. Fannie Mae and Freddie Mac 100% allow for a recast as long as it's $10,000 and they can do it as many times as they want.
So at any time that they do it, they keep their interest rate, so there's no risk involved with
Yeah,
that.
10 years down the road, they get a big old inheritance and they want to get a lower mortgage payment, but they don't want to refinance because rates are higher. Just do a principal reduction and recast.
Interesting. I didn't know that. So if you have a conforming, if Fannie or Freddie are your servicers, you can call them and say, hey, I want to recast my loan at this time?
Correct.
I didn't know that.
Yeah.
That's
And
almost like
most
a, that's like
servicers-
I did not know that. We
We
should
used-
actually, absolutely.
Yeah.
That's going to be my next video.
Okay.
To my database.
That's like an
100%.
Yeah, so that's sometimes
Yeah.
too is when we're talking with customers about that, and like that's where I think lenders sometimes, you know, like I'll just say it. So, like we could refinance a customer and get rid of mortgage insurance, right? But they might just be able to get an appraisal and do a recast.
For
and
sure,
come in
but
with
they
the
wanna
money.
refinance
They wanna
it to get
refinance. They want to
the
refinance
money.
the loan,
Yeah.
get the money to do another home loan. But yeah, someone can just come in with money, do a principal reduction, and recast the loan.
Hmm.
Yeah.
Yeah.
Now, not every servicer is going to do that, but Movement, we service our loans, and our servicer, Movement Mortgage, allows for a recast.
Yeah.
We don't service our jumbo loans, and you can't do recasts on jumbo.
Okay.
So if we have clients in our database right now that want to lower their mortgage payment, they have some liquid cash they want to put towards that without refinancing and paying fees and whatnot,
Yeah.
right? We can advise them that if Fannie is the servicer,
Yeah,
or
Fannie
maybe
or
like
Freddie.
Freedom.
Yeah, so I would just advise them to reach out to their servicer and ask
Servicers.
if they can do a recast.
Cool.
Yeah, if they want to do that, and they can do a recast.
Yeah, so that's the way that we're going to get buyers. If you guys are running across buyers who maybe own a home and they say, well, I don't want to do that, the recast is the way to do it.
The other thing, and I'll stop with this, unless you ask other questions. So the other thing we can do is we can do custom loan terms. So like if someone has 27 years left on their loan and they're looking to move up, they don't want to go to a new 30-year fix, I can just put them in a new 27-year. I can put them in a 26-year, I can put them in a 28-year. It doesn't have to be 30, 25, 20, 15.
Yeah.
Yeah.
Oh, that's cool.
What about refinancing to keep the same term
Yep,
too?
we do it
Okay.
all the time. So
Yeah.
I think often clients mismanage the opportunity to refinance.
Yeah.
Right? They look at the $200 a month in savings and it feels great because they're saving $200 a month, but they're 5 years into their loan and they're starting the loan over to a new 30-year fixed.
Yeah.
So we can do a new 25, 26. I can do it to the month, a new loan. So we can reduce their interest rate and not increase their term. Now, clients come to us for various reasons to refinance, right? One is, I just need to save money, right? Like kids went to college, like we gotta reduce debt. Okay, well then let's just reduce debt. But sometimes it's like only if it makes sense. Okay, so what we typically show them is we show them a new 30-year fix for the refi through our mortgage coach, which is really cool. A new 30-year fix. We'll show them taking the savings and applying towards principal and how quickly it pays off the loan, and then we'll show them a new loan with a lower rate at their current term. And then we stack rank those options against their current mortgage, and then show them benefit over time.
Wow.
Mm-hmm.
I've never heard of that.
Yeah.
What?
Recasting.
Yeah.
We talked about it with, you and I talked about it with
Nicole?
Mhm.
Oh, I was trying to compare that with bridging, right? I mean, how
It's-
similar is that with bridging?
It's kind of a similar theory. It's allowing them access to a loan, but it's just a cheaper route. Like a bridge loan is like
route, and it's
almost
kind
like a
of-
HELOC.
Exactly.
Yeah.
A bridge loan is a bridge. It's a loan in between typically. And so a lot of times on the bridge loan, they're cross collateralizing both homes.
Yeah.
So they're putting a loan on both homes.
Oh.
And then once that house is paying off, then they're moving it over there. Lots of different types of bridge loans that they do. I don't have any right now.
It would be like a second on your home to get the equity to buy.
Yeah.
Right.
Yeah.
Versus if you have the 5, 10, 20% down now,
Right.
using that, right? So we that's going to be the perfect option for the guys I just sent you.
Okay.
Right. So they have access to 70, 100,000. Want to buy up to 750. Boom. They can.
Yeah.
They can.
We just have the 569, 250 max loan amount.
Okay.
Yeah. That's the
Well,
only
they can get more money.
Okay, yeah.
What is the maximum gift someone can borrow?
There's
to
no
buy?
maximum.
Really?
Yeah. So Fannie Mae and Freddie Mac, every single penny used. Fannie Mae, Freddie Mac, FHA, USDA, every single penny used. Cash, down payment, closing costs, everything can be gifted.
Yeah.
Jumbo loans are the only products that have a requirement that the borrower has to bring in their own investment.
Got it.
So then it's usually half of the down payment. So someone's doing 10% down, 5% has to be.
What about for the IRS? Is there a carve out for if they receive gift funds to purchase a home?
Yeah, so that's the interesting thing with the IRS. And so like, very candid conversation. We don't report anything to the IRS. The purposes of a gift letter for us is that there's
This is
no
on
is
video.
that there's no repayment terms. Sure.
I'm just kidding.
So but I'm just saying we don't.
Yeah,
we don't.
you don't.
Well, the reason I'm saying that though is it a gift? Is it like if they're buying a home, is it a gift if the money's coming back? Is it a gift if they're on title? You know what I'm saying?
Yeah.
So it's all about the decision that if it is a gift and taxable that conversation has to happen with their CPA.
Tax advisor, yeah.
Exactly.
Yeah.
Because it may not be, they're thinking it is a gift, but it may not be a taxable event. Now, big disclosure on the walls, I'm not a CPA, I can't give tax advice, right? But anybody can give someone $15,000 a year.
Yep.
So one of the things that we'll do is, so let's say husband and wife are on the transaction, and then mom and dad are going to want to gift a large sum of money. Well, dad can gift 14 to son.
Yep.
Dad can give 14 to daughter. Mom can give 14 to son. Mom can give 14. So it's 4 different gifts, 4
Yeah.
different transfers, 4 different gift letters, but we're bypassing that gift tax. The other thing is there's an inheritance tax. And so when you die and you pass on your inheritance, it's like $2.5 or $3.5 million can be transferred to your heirs tax free. Well, that's a lifetime thing. So if you have $2.5 million to give upon death,
You could do it over
you
time.
gave $100,000 while you were alive, then you can only give 2.4 upon death.
Mm-hmm.
Does that make sense?
Do you have to
And-
call it an inheritance? You just call it
No,
something else?
their CPA needs to work with them through
Oh,
that.
okay.
Mhm.
But again, it's all those conversations you need to have with the CPA as to what is and is not taxable.
Mm-hmm.
Oh.
You know, and we can always just throw someone on title like that. We do deed only transactions. So just because they don't have to be on the loan to be on title and have ownership.
Yep.
Does that make sense?
Yeah.
And if
They
they're
can
on
always
title,
take 'em off title
if they're on title,
later.
it's not a gift.
Yeah.
Got it.
Yeah. So they can just quit claim deed them off later if it's a problem.
I mean,
It's up to them.
It's up to them.
Yeah.
But the purposes of us closing is they're on title. It's not a gift. They're having ownership of the home. They're just not on the loan.
Yeah. Yeah.
Sometimes you just have to take a minute and think about it.
Yeah.
Think about it. You know.
Yeah. So what are some good ways, because it's one now.
Yeah.
What are some good ways to make sure that we're sending you qualified people over, right? And then one other question I have is people for credit repair.
Yes.
Right. So let's say, is there someone wanting to get in? Let's say someone needs credit repair. No. What are we doing with them? Like-
Blue Water credit.
Referring them to Blue Water.
Yeah, so
Okay.
when we pull someone's credit report and it comes in and it's just like, it's not like, hey, we need 10, 15 points. It's like, it's a 520, you know? And they need a lot of work. Or, you know, because you can look at a credit report and immediately tell that it's gonna take a while for them to do it.
For sure.
Right? What we're doing is we're letting them, I wanna give them, like, begin with the end in mind. Like, if you fix these things, here's a basic idea what you can qualify for. So we're not doing the full pre-approval, but we're letting them know, like, okay, you've got good income, you've got good assets. If you fix a credit score, you could probably qualify for about a $350,000 home.
Right.
So they have like a goal in mind. And then we ask them, is it okay if we refer you over to Blue Water Credit? And at that point in time, if they say yes, and we do our little Blue Water Credit spiel, but if they say yes, then we actually send